Hello traders, in this particular video we are diving into a crucial MT4 strategy, all right, and that is liquidity grab breakoff structure. Okay, so basically we are going to focus on catching the fake outs so that you know exactly when the market is trying to trick traders before making its real move. First of all, let us define a liquidity grab. All right. A liquidity grab happens when the market moves to trigger stop loss orders or shake out weak positions. All right. So smart market participants hunt liquidity to fill their orders before the price reverses. Think of it as a test. All right. Think of it as a test. The market pushes price to areas where many orders are clustered. Right? It's often beyond an obvious support, like what we can see happen here, right? It's often beyond an obvious support or a resistance. So after the liquidity is captured, the market often reverses sharply, creating what we call a fake out. So next is the break of structure, yeah, or the BOS for short. The BOS occurs when price breaks a key swing high or low, signaling a potential trend change. The problem is not every BOS is real. All right. Some are part of a liquidity grab designed to trick traders into entering too early. Now, on MT4, you can identify BOS by marking swing highs and lows. For example, you can see that we actually had a swing high here, right? We had a swing high here. You can see this zone, right? We had a swing low here, right? We had a swing low here. So in this case, you can see that this structure was broken to the downside. Okay. So you watch for zones where the price breaks structure but hesitates or reverses quickly. That hesitation is your first clue that it might be a fake out. So how do we catch fake out? You have to look for confluence between liquidity zones and a BOS. Okay, price will often spike beyond support or resistance, capturing stops, then immediately reverse. For example, those who would have entered a buy trade around this support zone most likely would have set their stop losses just below this zone, right? But guess what? They would have gotten stopped out. They would have gotten stopped out before price reverses back in the direction, and that's quite a painful experience. Okay, so price will often spike beyond support or resistance, capture stops, and then immediately reverse. Volume, wicks, and price rejection patterns give additional confirmation. If a candle pierces a swing high but closes back inside, that's a classic fake out signal. All right, waiting for the close before entering ensures that you are trading the real move and not the trick. That is the reason why it's always good to wait for confirmation candlestick patterns. Whenever a candle is forming, allow the candle to form completely so that you can know whether it's going to be a rejection candle, whether it's going to be an engulfing or whatnot, right? Whatever candlestick pattern that is going to form, you need to allow it to finish forming for you to be able to define what candlestick pattern it is. All right. Now, timing your entry is everything. Once the fake out is confirmed, you enter in the direction opposite the false breakout. You place your stops just beyond the extreme of the liquidity grab. Okay, you don't want to fall victim of liquidity grab after you've already identified it. Imagine after this particular fake out, yeah, you enter the buy trade, perhaps at some point after this bullish engulfing that we had here, and then you set your stop loss here. You'd have gotten stopped out again after this particular leg down, right? You'd have gotten stopped out because it seems like we had a double bottom. We had a double bottom here before we had the reversal. So if you had jumped in quickly, set to stop here, well, you've gotten stopped out. But if you had set to stop some pips below that lowest point, even though that this attempt might have gotten very close to your stop loss, depending on how close you had set it to this, right? But if you had set it, quite some distance away that lowest point, after you must have seen this bullish candle, because at the end of the day, price is still going to do whatever you want to do, right? So after you must have seen this strong bullish candle, it would have given you an idea that this possible fake out was over, right? So you just give some pips below and you set your stop loss. At least if you had set it some reasonable pips below, you wouldn't have gotten stopped out by this move. But if you had given it a tight stop loss, then you would have gotten stopped out before the actual bullish move. You can see how long this bullish move was. It would have been a sad experience to have gotten stopped out and missed out of this, long bullish move. Okay, so what am I trying to say? Just always try to pay attention to confirmations and try to be careful when you are being tight with your stop losses. Okay, keep your target zones aligned with previous support and resistance or structural levels on your MT4 chart. So this strategy keeps your trades disciplined and avoids chasing the market blindly. Okay, so that is the liquidity grab break of structure on MT4 strategy for spotting fake outs. All right, by understanding liquidity hunts and break of structure, you can avoid getting trapped in false moves and trade with more confidence. All right, so if you found this video useful, like the video, subscribe to the channel, and hit the notification bell so that you can stay updated with more actionable trading strategies. Meanwhile, you can start applying this method on your demo charts today and catch those fake outs before they trick you. Okay, once you've gotten some level of experience and consistent profitability, then you can switch to your live account. Thank you for watching. See you in the next video.